Warren Buffett founded his first investment company, the Buffett Partnership, when he was only 25 years old. Between 1957 and 1969, Buffett's investment company generated returns of, on average, 29.5%. The noteworthy aspect of Warren Buffett's investing strategy is that he employs really straightforward techniques to generate these significant gains. You don't have to be a rocket scientist, according to Warren Buffett. A person with a 160 IQ does not necessarily outperform a person with a 130 IQ in the game of investing. Reasonability is crucial. Being logical, adhering to straightforward tactics, and maintaining those plans under duress are thus the keys to generating enormous returns. I want to share with you the 7 investment principles that Warren Buffett used to achieve such a high return. However, I cannot guarantee that your return will be as good as Buffett's. He is, after all, an extremely intelligent man who has devoted his entire life to investment. But if you take Warren Buffett's 7 investment tips to heart, you'll noticeably boost your overall long-term return. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 1. Buy business success, not stock gains. When Warren Buffett first read The Intelligent Investor, one of the best financial books of all time, by Benjamin Graham, he discovered this rule. Graham subsequently came to be regarded as a mentor by Buffett. One of the book's rules was pretty simple to comprehend. Buffett was convinced that purchasing stocks entails having a share in a company and that, over time, the stock will increase if the business does well. Find businesses with a bright future, a healthy profit margin, a competitive edge over the competition, and a good track record with clients. It doesn't have to be difficult. Stocks are a component of the firm, and you will profit if their operations are profitable. Number 2. Most news is not actual news. Despite Buffett's unpopular opinion, most news stories you read have little to do with investments. Indeed, news outlets like CNBC, news websites, and financial YouTubers are all paid to increase their viewership. Therefore, they exert all of their efforts to create a stir or cause concern in order to gain those views and increase their income. Only around 5% of that news needs your attention. Buffett claims, however, that investors frequently let their fellow investors' unpredictable and frequently illogical acts influence their own decisions. Some investors think it is crucial to listen to experts because there is so much talk about the markets, the economy, interest rates, stock price behavior, etc. And to make matters worse, they firmly believe that their suggestions must be followed. The majority of the news and the pundits are not worth thinking about. Just concentrate on the most important details. Number 3. Not everyone is trustworthy. I'm assuming you already know how important compound interest is in terms of finance. You can generate a lot of money if you receive dividends or capital gains and let them compound and develop like a snowball. But if you constantly buying and selling stocks, compound interest won't have a chance to do its magic, and you'll lose out on a lot of gains. They contend that everything in the markets depends on timing rather than just time. The key to profitable stock investment is to envision oneself as the lifelong owner of higher quality companies. So for more than 25 years, Buffett has held stock in American Express, Wells Fargo, and Coca-Cola. The great Philip Arthur Fisher famously stated, "If the job has been done well, the moment to sell is nearly never when a common stock is purchased." You can improve your wealth by reinvested dividend and capital gain income. Therefore, rather than attempting to time the markets, timing the markets is essential. You ought to be prepared to hold onto the stock indefinitely as a result. There is usually never a good moment to sell when you complete your research before making a buy. Number 4. Plan on holding forever. We are not in this alone, which is one of the best things about investing. Even Warren Buffett has regularly listened to and taken advice from other investors over the course of his career. When he was younger, Benjamin Graham, a financial expert, taught him the basics of investing. The good news is that we may also learn from and pay attention to successful investors. Charlie Munger was typically on his side as he grew older to make sure he had the proper perspective on things. We have access to both the complete list of equities that Warren Buffett owns and his annual stock purchases. The most important thing is to pay attention to those we already know and trust, even though Charlie Munger and Ray Dalio frequently share their opinions on CNBC. Do we really need to listen to that CNBC expert who is constantly discussing the newest trends, or to that up-and-coming YouTuber who is receiving a lot of views and who is urging us to buy Tesla stock? Do they have a grasp of investing? Do they understand what each stock's intrinsic value is? Don't listen to someone you don't know and trust. Number 5. Know intrinsic value. Understanding the company you're investing in is a relatively straightforward concept, yet few individuals actually do it. How many relatively simple firms Warren Buffett owns stands out as one component of his portfolio? Coca-Cola is a firm you have. They used to solely sell soft drinks, but recently they also begun selling meals. Selling tickets is how Southwest Airlines generates revenue. Furniture is sold at Furniture Mart. iPhones are available from Apple, a retailer of technology. Warren Buffett takes great care to fully comprehend a firm before investing in its stock, and you should do the same. Look further and investigate Tesla, Ford, and Toyota if you're interested in automobiles. If you enjoy internet shopping, I recommend checking out Amazon and Alibaba. Look at companies like Alphabet, which owns Google and YouTube, if you enjoy the internet world. A stock is a financial instrument that can be bought for almost any activity or interest. Invest only in companies you can comprehend. Number 6. Understand what you're buying. This guideline is especially applicable given the state of the market today. The noteworthy part of the current market situation is that equity prices have increased by more than 300% during the period of the past 11 years of our current bull market. Since everything has been rising and everyone is gaining money, everyone believes they are experts in the stock market. The result of this is evident conclusion. Everyone develops greed because they are self-assured and skilled investors. What impact do you anticipate this will currently have on stock prices? So, raise prices considerably. As investor interest rises as a result of rising stock prices, it becomes more and more difficult each day to locate a bargain on the stock market. We must be cautious and fearful when making investments in these unsettling times, and Buffett is doing just that. He owns $128 billion in cash and $214 billion in publicly traded equity. There is a substantial sum of money there. Due to the market's current condition, he is being extremely cautious. However, you can bet your bottom dollar that Warren Buffett's greed will take over and he will start buying a lot of stocks when they are on sale as soon as stock market anxiety starts to set in. Number 7. Be fearful when others are greedy. When it comes to investing, if you don't go by this guideline, all the others are useless, and your plan will fail. No matter how amazing the firm, the managers, or your knowledge of the industry are, it is not worth an indefinite price. Make sure the price you are paying is lower than the item's actual value or equal to it. Imagine you want to purchase a Lamborghini. There is no questioning this car's exceptional quality and durability. There is no denying that the designers of this car gave it a great deal of thought and accuracy. The most important query, though, is the purchase price fair? Is it truly worth $350,000? Keep in mind that neither a stock nor a vehicle may have an unlimited value. No company, no matter how smart, is worth an unending price, according to Warren Buffett. Price is what you pay. Value is what you receive. Each stock's intrinsic worth must be understood in order to fully appreciate its market value. This is it for today's video. What do you think of our video? Which rule do you like most? Let us know in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.